Hello, I'm here again, and this is the 10th episode of Who Said What. Thank you for coming in every week for the past 10 weeks so that I have something to show to my manager during appraisals. If you're new here, I am Krishna, and in this show, I dive into interesting comments made by notable figures from across the world, whether it's finance or the broader business world, and dig into the stories behind them. Today, I have 5 very interesting comments for you. For the first one, a video from LiveMint made a bunch of people mad on Twitter. Before you ask me, are you on Twitter all the time? No, it's not me, but my boss Bhuvan. Anyway, in the video, journalist Neil Burate cites research from one of their previous articles around fund managers.
From Mint has gone viral about how India has only a few fund managers with experience of more than 15 years. The vast majority of India's fund managers have only a few years of experience, and this matters because fund managers, in order to do a good job, need to have seen multiple market cycles.
The article basically says that only a tiny fraction of fund managers show a 15 plus year stint on the same scheme. At first glance, that's alarming. Most investors expect their fund manager to have navigated multiple bull and bear cycles, such as the 2008 crash or the first COVID lockdown. The column cites familiar veterans like S. Narain and Prashant Jain, describing them as among the few who have stayed with a single fund for such a long stretch. However, there's one tiny nuance in all of this. The dataset counts each manager scheme combo separately. If a single manager oversees two different equity funds for different durations, that individual appears twice, once for each scheme. And it seems like this didn't sit right with a bunch of people from the industry. Radhika Gupta, CEO of Edelweiss AMC, called the conclusion strange, pointing out that many managers have 25 plus years of industry experience but might have joined a new fund or AMC only recently. Another tweet I saw said that even an industry stalwart like S. Narain appears inexperienced if you only consider his tenure managing each specific scheme. Pavitra Parekh of Mirae Asset likened it to an experienced surgeon switching hospitals. No one would suggest that their expertise vanishes overnight. There's another critical nuance that the Mint column doesn't fully explore. In some fund categories, the manager's role is less critical. Index funds and certain debt funds, for instance, are driven more by a set process than by active market calls. An index fund manager's main task is to track the benchmark like the Nifty or Sensex and keep tracking error low. In short-term debt funds, especially those focused on overnight or liquid instruments, the manager has limited discretion. Much of the return depends on adhering to guidelines around credit quality and liquidity. Hence, while the Mint piece warns that shorter specific tenures might mean fewer experiences with market crisis, critics note that for passive or formula-driven funds, the scheme history metric might not be as relevant. You don't necessarily need a star manager in an index fund. You just want someone who reliably replicates the index. Also, there's one thing to note. Past performance is not an indication of future returns. Just because a fund manager or a mutual fund has delivered excellent returns in the past doesn't mean they will continue to do so. Now, on to the second story. How many schemes is too many schemes? This one's another tweet from Neil Burate. He posted an infographic that shows how some of India's biggest AMCs have piled up dozens of mutual fund schemes, often leaving investors with overlapping portfolios and unnecessary fees. According to him, the industry's constant stream of new funds can nudge you into owning the entire market but at a higher cost and with more taxes. Of course, after this, people from the finance industry joined in on this. Nilesh Shah, MD at Kotak AMC, says the sheer number of choices isn't really the issue. In his words, it's like having tons of restaurants around. You don't need to shut them all down or stop eating out altogether. You just need to find a good dietitian who will help you pick what's right for you. Meanwhile, Deepak Shenoy, founder of Capital Mind, pointed out that new launches can mean bigger distributor commissions. Now let me give you some context around mutual fund categories. Back in 2018, SEBI introduced new guidelines requiring mutual funds to clean up their offerings and clearly define each fund's category and objectives. The idea was that standardizing categories, large cap, mid cap, multi cap, and so on, would reduce confusion for retail investors like you and me. But Amit Kumar, founder of Fintech Capital, believes that despite the 2018 reclassification, the scheme names and intended objectives have started overlapping big time now. such that no layperson can make any sense of them. Funds labeled business cycle, cyclical, or discovery might have distinct names but often end up investing in the same space. In other words, marketing spin seems to be overtaking the actual differences in strategy or portfolio composition. According to him, a full revamp of mutual fund categories by SEBI and AMFI is needed. And in his view, these major overhauls often happen only in a bear market when the flaws in the system become too obvious to ignore. At the end of the day, this whole thing raises a big question about whether we genuinely need so many schemes or if it's just mostly marketing. Tell me, what do you think? Do we have too many schemes? Let me know in the comments below. For the third story, I'll talk about valuations. If you remember, last week I broke down what Ashwath Damodaran and Shankara Narain had to say about valuations. And let's just say opinions were flying. Damodaran called India the most expensive market in the world, and Narain went full 2008 crisis mode, warning investors about small caps. But this week I came across something just as interesting. A tweet from Samit Vartak, the Chief Investment Officer at Sage One Investment, got my attention. Samit, for your context, is someone who has long championed mid and small cap investing. In his post, he dissected how valuations for different market segments, large cap, mid caps, and small caps, can often be misleading. He pointed out that PSUs and banks generally trade at lower PE ratios, and because these stocks make up a larger chunk of the large cap universe, they distort the weighted average PE multiple. His key argument is this: using broad PE ratios to compare large, mid, and small caps is like comparing apples to oranges. Now, here's where things get interesting. He argues that in large caps, PSUs contribute 33% of total profits, while in small caps, their contribution is only 9%. The weighted average PE of large cap universe is 21.6 compared to 29.9 for small caps. But if you strip out PSUs and private banks, the median PE for large caps jumped to 42, while small cap drops to 33.3. This flips the entire valuation debate on its head. The popular narrative right now is that small caps are widely expensive, but if you adjust for composition, they may not be as stretched as people think. But this all is just one side of the story. In an interview with ET Now, he gave a more nuanced take on small and mid caps. First, he acknowledged the excesses of the past couple of years. He pointed out that during the bull run, investors were throwing money into small caps without doing any real due diligence. They were buying first and researching later. This created an environment where stocks were rallying purely on momentum, not fundamentals. He specifically called out pre-IPO and IPO deals where companies were selling a dream, projecting 4 to 5x revenue growth in just a few years. To this, Samit
It's
said,
impossible, when thousands of companies are projecting such kind of a growth.
and yet many investors were buying into these stories without questioning them. So, is the small and mid cap correction over? Not entirely. He thinks there's still a lot of froth in the market, especially among companies that benefited from speculative excesses. But for stock pickers, this correction is actually creating opportunities. His biggest takeaway is that if you're investing in small and mid caps, don't just go by market cap. Bet on business quality, promoter integrity, and market leadership. He says days of blindly buying an index or a theme are over. Now, on to what's happening in the markets right now. The markets have come off their peaks, and if you look at the numbers, the drawdown is significant. Nifty 50 is down around 9%. Mid caps are even deeper, with Nifty Mid Cap 150 falling close to 15%. Small caps have been hit the hardest, with Nifty Small Cap 250 down around 19%. All of this as of 21st Feb. Another interesting perspective came from Deepak Shanoy. He acknowledged the pain in the markets, but he had a slightly more balanced view. In his tweet, he said, "Markets are going to be rough a little, and while I also think the fall seems stretched, there is no predicting when it will stop. The corrections now are between 10% and 25%, and it's been slow. It will take time to recover, but there's more to buy now than in September." Now, this is a critical point. While people are panicking, corrections create opportunities. Deepak Shanoy isn't dismissing the fall, but he is also saying that if you have a long-term view, there's a lot more value on the table today than just a few months back. Now, where does all this leave us? One thing that I took away last week and again this time is that valuations alone don't say everything. Valuation numbers mean nothing unless you know what's behind them. If you know where to look, there's a lot to buy. But the latter is the hard part, isn't it? Now, for the fourth story, I'll talk about deregulation. Pranay Kotastane, who writes about public policy and is the deputy director of Takshashila Institution, he wrote about deregulation recently. His piece, which is mostly written in Hindi, reacts to the bold statements on deregulation in the Economic Survey's preface. In the preface, Chief Economic Advisor boldly states that the government should stop micromanaging economic activity and get out of the way of entrepreneurs. Pranay included this striking quote from survey's preface. Now he wrote this in Hindi. I'll pick exactly what the preface said. The biggest contribution governments can make to businesses is simply to get out of their way. If governments do not regulate with caution and immediately end burdensome rules, entrepreneurs will never be able to focus on innovation or competition. The government must learn to trust entrepreneurs and businesses. Pranay points out that this honesty about cutting red tape is refreshing and long overdue. To illustrate why reducing regulatory barriers matters so much, he shares one of India's best known examples, the Maruti story. While many believe Maruti thrived because India protected it behind heavy import barriers, Pranay highlights a more nuanced truth. Drawing on Monty Singh Ahluwalia's book, Backstage, the story behind India's high growth years, he shows that Maruti actually took off once it enjoyed exceptions to the usual licensing chaos. To put it simply, the government allowed foreign collaboration, eased production limits, and relaxed certain license hurdles, giving Maruti room to scale up and succeed. Pranay said this in his blog, which was in Hindi, but let me translate that for you. In reality, many of India's major success stories are outcomes of deregulation, although we often overlook that fact. For example, if you ask someone why Maruti succeeded, most people will say it's because India kept foreign players out and supported domestic brand. But the truth is, Maruti was successful precisely because it was granted more flexibility at the right time, that is, deregulation. Pranay observes that once India extended that kind of deregulatory push behind Maruti, especially during the broader economic reforms of 1990s, scores of other industries began to flourish. This, he says, is exactly the point of Economic Survey's preface. The chief economic advisor argues that simplifying regulations cuts cost for businesses and unleashes entrepreneurship by freeing people from mind-boggling compliance structures. According to the preface, lowering the cost of business through deregulation will make a significant contribution to accelerating economic growth and employment amidst unprecedented global challenges. But it's not about having zero rules. The survey particularly emphasizes on smart, streamlined, risk-based regulation where the government stands ready to address genuine risks but otherwise trust businesses to get on with their work. In a similar vein, Uday Kotak has also underscored the need for India to move from what he calls micromanagement towards genuine growth and competition. I'm quoting from a Kotak report on what he spoke about at the event. In his view, India cannot afford protectionism. India has to take advantage of changing times and make Indian industry competitive than protective. The new world will give limited options to run large current account deficit. He emphasized the need for India to improve productivity, avoid excessive protectionism, and 3. Increase manufacturing as a percentage of GDP. He also highlighted the importance of execution in both macro and microeconomic policies. He echoed the chief economic advisor's call to streamline red tape. In Uday Kotak's view, trusting entrepreneurs and letting them innovate while still guarding against genuine risks has played a significant role in India's past successes, and it will be vital for sustaining growth in the coming decade. Now, on to the final story. In 2012, Mario Draghi uttered 3 words that would save the euro: whatever it takes. As the president of European Central Bank, he promised to preserve the eurozone's currency at all costs. The markets listened and the crisis subsided. Now, in 2025, Draghi has a new message for Europe, but this time it's tinged with frustration.
But do something.
Speaking to the European Parliament, About his report on competitiveness, the former ECB president and Italian prime minister laid bare his exasperation with European inaction.
You say no to public debt. You say no to the single market. You say no to create the capital market union. You can't say no to everything.
But what's driving this urgent call to action? Draghi's comprehensive speech reveals a Europe facing multiple existential challenges. First, there's the AI gap. Europe is falling behind, with 8 out of top 10 large language models developed in the US and the remaining 2 in China. Every day of delay, as Draghi puts it, the technology frontier is moving away from us. Then there's the energy crisis. European power prices are 2 to 3 times higher than in the US. During a recent cold spell in December, when solar and wind power generation dropped to near zero, German power prices skyrocketed to 10 times their yearly average. This isn't just about keeping the lights on, it's about maintaining European industrial competitiveness. Yet, out of all of this, perhaps the most striking is Draghi's revelation about Europe's internal market. While the Europe's market is similar in size to that of US, internal barriers are equivalent to a tariff of 44% for manufacturing and a staggering 110% for services. As Draghi notes, we are often our own worst enemy.
We are often our worst enemy in this regard.
The irony, Europe has the savings, sending over 300 billion euros annually overseas because investment opportunities are lacking at home. It has the market size comparable to that of US. It even has the industrial base employing 30 million people in manufacturing compared to 13 million in the US. But if Europe's economy needs a jolt, it is Germany's troubles that are sounding the loudest alarms. Europe's industrial powerhouse has lost almost 250,000 manufacturing jobs since the start of COVID pandemic. Industries from automotive to chemicals warning of further cuts. High energy cost, consumer malice and competition from China are threatening that was once the bedrock of European growth. German politicians bracing for elections have begun to speak openly of deindustrializations if energy costs remain so high and investments continue moving abroad. For Europe's biggest economy to sputter now amid all other crises only deepens Draghi's sense of urgency. Meanwhile, Europe's security dilemma is taking on new dimensions. 12 years ago, Draghi's whatever it takes speech saved the euro through the power of conviction. Today, his do something plea reveals a different kind of crisis, not one of immediate market panic but of gradual decline in the face of technological and geopolitical change. Another critical vulnerability Draghi highlights is Europe's fragmented defense industry. Despite being the world's third largest defense spender collectively, Europe's national defense systems aren't interoperable or standardized. As Draghi puts it, this is one of the many examples where the European Union is less than the sum of its parts. Yet, there's a deeper issue: trust between allies. A Financial Times editorial recently asked, is US still an ally? Has it become an adversary? Some European officials worry that Washington might turn inward or make separate deals with Russia, leaving Europe dangerously exposed. Meanwhile, the columnist warns that Europeans must cut back their dangerous dependence on America that might no longer be reliable. Europe's economic problems are closely tied to the geopolitical situation, especially if it has to handle more of its own defense while the US commitment wavers. The scale of the challenge is massive. Draghi estimates Europe needs 750 to 800 billion euros annually in investment. While the European Commission has proposed streamlining Europe financing instruments, there are no plans for new European funds. Instead, the success depends on member states being willing to use their fiscal space within a European framework. Draghi warns that if recent statements are any indication, Europe may be left largely alone to guarantee security in Ukraine and in Europe itself. It's a sobering reminder that Germany's industrial strains, high energy costs, and Europe's fractured defense structures all converge in a moment when the US might not be the most reliable partner it once was. The question now is, will Europe listen this time? That's all for this episode. Thank you for tuning in. If you have any feedback for me, please let me know in the comments below. At first glance, yeah, you can pause. This is the final story. तक 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 क्या बोल रहा हूँ यार. Sorry that you have to suffer. Have you had lunch? मुझे लग रहा है भूख के वजह से खत्म करके खाऊंगा.